What is up? This is the Working Investor. In this video, we're going to talk about why I have Berkshire Hathaway Group B in my YieldMaxian degenerate portfolio. And you're probably wondering, what on earth is a non-income asset doing in an income portfolio? And I would tell you would be correct that it's not really an income type of fund, but I use it as a hedge to keep my fund more stable. So when the market does crazy stuff, if I wanted to take money out from my fund, I would feel comfortable taking out money from the fund because my net value stays around balance. So why Berkshire Hathaway? And before we get into that, let's look into the hedges, which you'll see I marked in red: CLOZ, CEFS, YGLD, IYRI, CTA, and I don't consider BIZD as a hedge, more of a diversifier, and then Berkshire Hathaway Group B. This is the first one that I put in that actually does not give a dividend. So these are the four reasons why I consider it a hedge in my portfolio. Number one, the behavior is different. Because there's no cover calls, it has uncapped large cap equity upside. It has a quality balance sheet exposure. It has a lot of drawdown resilience, and it has fundamental value exposure. One of the parameters I look into when I look for hedges is that I don't just want to have a hedge. I want to have a hedge that in itself does pretty decent returns, ideally matching or even beating the S&P 500. So having this hedge could possibly even beat the S&P 500. And this definitely checks all those boxes. If you go on the 5-year chart of Berkshire Hathaway compared to S&P 500, and look at total return over the past 5 years, you'll see that Berkshire Hathaway delivered about double what the S&P 500 did. And if you go to the past year to date, this really shines. You see a massive diversion where BRK is in orange and S&P is in blue. And you see that when the market was suffering hard, Berkshire Hathaway was doing really well. So let me explain to you why this phenomenon happened. And by the way, nothing here is any type of advice, whether financial, legal, accounting, or whatever type of advice, tax advice. Please seek out your professionals and take your own risk. Anyways, so the reason is because there's two types of categories of funds. There's deep value funds that when you buy the stock, you're getting a decent price compared to the money that the company is generating. And then there are companies that are disproportionately, the stock is way too expensive to justify the price of what they're actually making. And there's a saying, when the tide goes down, you could see who's been swimming naked. I think Warren Buffett said that. So when the tide goes down, you see those hype companies kind of naked, and then the value companies on the right sitting comfortably. So the market basically has different categories. There's mid cap, there's small cap, mid cap, and large capitalization. If you think about a company that's very high in its capitalization, when there's something going on, a pandemic or whatever you name it, they have more resiliency to make their books than a small company that could get decimated in a down cycle. And in addition to that, there's companies that are categorized as good value, that the price you're paying for the stock is appropriate compared to the value of the company based on its peers, or the PE ratio. And the PE ratio relative to its peers. And then there's growth where, the P ratio is out of control, the price to earning ratio is out of control. And then there's a blend where there's a mix. So Berkshire Hathaway, a lot of its companies are basically in the large cap value. And about 50% of Berkshire Hathaway is not just the companies that it holds, but it's also its own business on top of it. And this is another way to explain it, that when we're in a bull run, the price of the stock is like a voting machine, that whatever the votes are saying it's worth a certain amount, that drives the price up. But whenever the market crashes and goes down, the stocks tend to go down to its proper value or closer to its proper value. So it becomes more of a weighing machine where you're weighing its value and you're giving a price based on the weight, not based on what people's sentiment is, market sentiment. So that's why I like deep value companies, especially to complement a lot of the other stuff that we have in YieldMax. So if you think about YieldMax, they look for the most volatile companies because they have good option premium. And just look at the big picture before we dig deeper into Berkshire Hathaway, is that if you look at the past 20 years, you could see that Berkshire Hathaway has outperformed the S&P. Maybe not as dramatically as recently, but 550% delivery versus 490% delivery in price. And if you look at the annualized return, it's 9.3 per year versus 8.9 per year. This includes all the bad years. The max drawdown, you could see it's kind of smudged out, but if you look at the bottom, you'll see the max drawdown for Berkshire Hathaway in 2008 was 37%. Compare that to 55% of the S&P 500. And then you have something called the Sharpe ratio, which is basically telling you risk-adjusted return. For every measure of risk that you're taking to invest in something, is the fruit worth the squeeze? Is the juice worth the squeeze? So the Sharpe ratio is 0.72. The higher the Sharpe ratio, the better the risk-adjusted return. And this is over a 20-year time frame. I know that recently when I checked the SPY, I found Sharpe ratios of 0.8 or something like that. But if you look at the big picture over a 20-year span, it delivered about a 0.72 Sharpe ratio for Berkshire Hathaway Group B and a 0.65 Sharpe ratio for SPY. So let's go now into Berkshire Hathaway. So if you look at the breakdown of Berkshire Hathaway, about 45 to 50% approximately is basically its own business. Like they have the railroad business, they're in energy, Geico, which is insurance, Precision Cast Parts, Duracell battery, Dairy Queen, She's Candies, etc. So they have their own businesses that they own. And then about 50 to 55% is their stocks that they own, like Apple. And let's look at their stocks. So around 55% of their stocks is Apple. And then you have, I think, Bank of America, American Express, Coca-Cola still there, 7.5%, Chevron, Occidental Petroleum, Kraft Heinz, Moody's, H&P, Davida. So these are like this is the top 10 holdings of Berkshire Hathaway, which comprises about 55% of their holding. And I looked at their PE ratio. It's about 12 to 14% versus the S&P, which is about 18+% PE ratio. So they have a better price to earning ratio. So they're by default more deep value. Like they're more in the large cap value on the top left versus the S&P, which is maybe a large cap blend, which is the top middle. So in this picture, the 4 points which I wanted to point out was we mentioned the second point, quality balance sheet exposure. We mentioned drawdown resilience, that it had less of a drawdown in 2008 crash. We mentioned the fundamental value exposure, but let's go to the first point of the uncapped large cap equity upside, that it kind of complements a lot of the YieldMax funds or other income funds that are option based, specifically cover call option based. So this is the behavior of the fund. So I call it also like a behavior overlay hedge, because when you have a lot of the capped upsides, you're kind of capped. When the market shoots up, you go up to an extent, and then you miss out on all that further upside. But with Berkshire Hathaway, if so much of one's portfolio is capped on the upside, like if you look at YieldMax, it's like the biggest holding, 42%. So much of the portfolio has capped upside. I need to have some uncapped upside and so much of it is on growth and hyper growth. So it's good to have a complementary deep large cap value with uncapped upside. So that's why I find this very interesting as a use case, in my personal opinion. I don't know what you guys want to do. This is my personal opinion. Of course, it's not going to deliver much income, but I'm thinking of building up for maybe 1 to 2% of the position of the portfolio, using the dividends to build out this hedge to give my portfolio a little bit more resiliency in a downward market. So yeah, let me know what you guys think about this type of strategy. What kind of hedges are you guys doing to have income, but have the income more stabilized, have income that you can use without seeing your overall value of the portfolio go down? Anyways, this is the Working Investor over and out. I hope you guys have a wonderful weekend.